title of this conference is Protecting Sustainable Societies. And of course that is a theme that you have already been able to follow throughout the entire morning. Let me first briefly introduce the panel and the colleagues I'm very happy to welcome here. I start with Elisabeth Stadler. She is the chairwoman and CEO of the Vienna Insurance Group and obviously also very active in Romania. I welcome also Susan Neely, the president and CEO of the American Council of Life Insurers. We have Sue Lewis. She is a trustee at the People's Pension in trustee director. But Sue was also already throughout your working life active in many consumer panels. Very happy to have you here. We look for your insight. We just had a very interesting contribution from a climate expert. Now we get the contribution from the consumer expert. Looking forward to that. And Victoria Saporta, I don't think you need any introduction, Vicky. People know you very well. She is the chairwoman of the International Association of Insurance Supervisors. Very happy to have you here. You also, in your daily life, have the post of Executive Director Prudential Policy at the Bank of England for Prudential Regulation. Very welcome to all of you and happy to have you here. And can I also say I'm very proud that this is the second time we managed to have a female panel. It's not a small... Okay, I start with you, Sue, if I may. So the topic is protecting sustainable societies. We have heard a lot this morning about the protection gap. Your analysis, why do consumers not buy protection? Where is the issue?
Okay, well, where to start? I'd like to come back to some of the things Adam said later. I'd say as a consumer rep, I'm not normally that popular at these conferences, but so thank you very much for inviting me. It's not often I find myself nodding vigorously when I hear someone from the industry speaking, but I was nodding when Oliver was speaking, and it kind of occurs to me that the position of the industry and the needs of consumers are not actually that far apart. And the question is, why? Why do people not buy protection? Number of reasons. Number one is just, it's a behavioural thing. It forces you to think about things you don't want to think about. You know, my car's going to crash, my house is going to get burgled, I'm going to get sick, I'm going to die. Nobody really wants to think about those things. So what you're buying is peace of mind. And that's quite a nebulous concept and quite a difficult sell. That's one thing. I just want to talk about financial education very briefly, and it goes to some of the things Oliver was saying. Now, I'm a big fan, along with Diana Crossan, who you will hear from later today. Diana and I have worked with colleagues on financial education for 15 years, so I'm for it, but it's necessary but not sufficient. Because when I hear people from the industry say, people just need financial education, I think, that means you don't want to explain things clearly. You expect consumers to come along. You don't want to give them simple products that are easy to understand. You want them to come along and read the 40 pages and get them. And I think those two things, we need to ask the question, what is the role of financial education? But more importantly, what is the role of industry in making things simpler? I mean, we've tried simple products in the UK. It doesn't work. It doesn't work. The industry, you know, players would say, because it's not profitable. But it could and should be profitable to provide a product and then maybe add some whistles and bells to it. You know, here's your basic product. If you want extra here, legal cover or whatever, this is what it will cost you. Because the important thing for consumers is to know what they're getting and what it costs. Very plainly, very clearly. And then I think we get into some of the issues of affordability, which actually we've talked about, that's kind of obvious. But there's issues about trust. And trust has been touched on a few times. I think in the UK, well, we've got a lot of problems in the UK, but the sort of insurance problem is that there's almost too much competition. So a lot of our general insurance products are sold through comparison websites. And then, of course, people go for the lowest price. And then when they come to claim, they find that the thing that they were going to claim on isn't covered because the policy has been hollowed out to make the price low. This is not good for consumers, but it's not good for the industry either, because the industry can't innovate. It can't show that it's providing better products or better services, so you get a lot of just mistrust. You get mistrust through renewal pricing. I mean, typically, somebody who stays with the same insurer for a long time will get a higher price. And insurance companies know this, and they're using big data to kind of segment the market and price people, not necessarily just according to the risk they pose, but according to their propensity to pay a higher premium. And that breeds mistrust as well. So somehow we have to break out of this cycle of then the insurance industry not trusting the consumer, because you've got a lot of insurance fraud. I mean, I know perfectly upstanding, law-abiding citizens who will pad a claim because somehow they think it's legitimate because the insurance company is ripping them off. So we have to break out of that cycle as well. I could go on for hours, but I won't. So there's a few sort of things I hope we can discuss in there.
Absolutely, very interesting. My first thought on it is actually, you know, I'm in a lot of these discussions, also with consumer representatives, but also within the industry. And I'm sometimes flabbergasted that what I see happening in terms of debate within the industry, where exactly these questions are discussed. You know? We shouldn't price customers that are very true to a brand. We shouldn't price them higher. There is a lot of debate about that. And there is a lot of movement, how can we address these issues? But it's not often translated then into this dialogue with the customer. And I think we also need to be better in explaining what we do and how much we do actually also within the industry.
Because that's actually the question I wanted to ask Oliver, and indeed any of you, is how to ensure that consumer view is represented at your board. Where is that discussion at board level? And if it's not there, then I think it should be.
Yeah.
And I don't just mean employee representatives, but I mean somebody who could genuinely bring that consumer view and say, hey, what about X, Y, and Z? Have you thought of that?
Okay. Very interesting. I maybe pass the question to the others who have heard so. I don't know, Elisabeth, you would like to start?
Yes, maybe. I think there are two essential aspects in my opinion. The one is how can we increase the protection level of the citizens and the business, and there are two aspects. One is the distribution and the other one is the risk transparency. I think we have heard some points about the distribution. I think all of you will agree insurance is and always will be more a push product rather than a pull product. I think nobody of the inhabitants or of the citizens or of our clients gets awake in the morning crying, oh, today I need to buy an insurance. If you compare it, for example, with the new handy or the newest iPhone. So therefore, I think it's very important that we see distribution as key to increase the protection level of the citizens and the business. And I think, of course, this starts with the conversation between the distributor on the one side and the customer or the client on the other side. You know, in Europe, we have a recent regulation, the Insurance Distribution Directive, so-called IDD, that we applied for even less than a year, and the IDD requests, I would say, a so-called demands and needs test. So it's very important that we truly have to explore our customer, we have to get known about the behavior of our customer, about the needs of the customer, and of course about the risk appetite of the customer. And I think, therefore, we need to take a 363 degrees perspective overall in all the different areas. So you mentioned it, insurance is a matter of trust, and I think trust is a very human element. So therefore, of course, we can need digital assistance for this, but we should not forget that we also need humans for these activities. And the second aspect, the risk transparency, I think we should all be aware, and the client should be aware of the individual risk exposure they have, and they should be aware in a convenient form. There are, in my opinion, some different good instruments. For example, some online pension calculators. We have heard about the pension gap already from Andreas Brandstetter, that there is really a need to save more for our personal retirement. And I think there are a lot of efforts, and these pension calculators are already active in some countries, but of course I would welcome this to become mainstream in Europe and maybe all over the world. Also, we see the digital risks for the natural disasters. For example, you can see whether your house or your production site is exposed to natural disasters. We have heard about this too. In Austria, we have a system called HORA, Hazard Overview and Risk Assessment, and we have this active for several years, and I think this is very nice institution, or very nice overview, that we get a good overview about all the risks, and I would welcome similar initiatives in all the other countries. And maybe last to name is the European Union Floods Directive. I think this is a very good step into the right direction, but this only requires risk maps for floods. And in my opinion, this should be extended to other natural perils like earthquake, storm, hail, and so on.
Interesting. Now a regulator's perspective. Vicky, what can regulators do? Is there something that you can also, raise awareness, the protection gap, also make it easier for the men in the street to understand the need for protection?
Yes, Michaela is sort of in an awkward position, because in my day job I'm a Prudential regulator, not a conduct regulator, but of course in my international role I have conduct as well. So I do observe what's happening in that world, although in the UK I'm not directly influenced it. I guess we are beginning to learn that if you want the mainstream orthodoxy, that the way to solve consumer problems is to be more transparent and to provide them with financial education is not working. I mean, there is a swathe of evidence coming from a lot of countries, including the country where I work, and that suggests that people are not reading, the vast majority of people in the UK, the fourth largest insurance market in the world, don't read the terms and conditions of insurance contracts, and very large numbers of them think that they're not getting the product that they need. Now, what do regulators, conduct regulators, consumer regulators, conduct regulators like the Financial Conduct Authority should do in this circumstance? I think traditionally in the UK they have faced a dilemma. They have seen the role mostly being about ensuring that the company does the right thing, rather than nudging the consumer directly. And the reason being that they think that nudging the consumer and getting the consumer to behave appropriately is not the role of the regulator. It's a social choice, and it's the role of the government. And given the fact that sort of perfect rational mainstream economics suggests that consumers are not perfectly rational and they have loads and loads of behavioral biases, nudging appears to be some sort of good policy to try to solve these behavioral biases. But is it the role of the regulator, or is it the role of society? I think increasingly what the conduct regulators in my jurisdiction seem to be doing is seem to be working more with government to try to nudge. At the same time, they are requiring companies to do the right thing for consumers. And just to give you an example, Sue actually would be even closer to that because she was involved in advocating for some of that. There is, as a result of the retirement outcomes review, it was found that people that were about to receive the defined contribution benefit were going to the insurance company and they were taking always the path of least resistance in a drawdown, always. If they hadn't had advice. Despite the plenty of information that is available if you read about investment choices and investment programs and the loads of charities that agree and NGOs in the UK, developed market, about it. So what the FCA is doing is requiring firms, they call it an investment pathways program, when somebody approaches them for a drawdown product, to give them a set of very simple products in response to certain questions. And this goes back to what I guess the conversation between Carol and Oliver was about earlier today. Consumers appear to need simplicity. But can I give you another example, a more macro in terms of a protection gap rather than micro? I think even governments need simplicity. So a huge problem, social problem, is the huge protection gap that exists in the world around natural disasters. And we heard the speech. I think in 2017 we had peak losses from natural catastrophes at around $340 billion. That's more than 10% of UK GDP. And I think most countries in the world have less GDP per year than that amount. And out of that, more than half was uninsured. And the vast majority is emerging and developed countries. Now, I think these governments also need to buy, and these businesses, simple products. And I think the development, for example, towards insured-linked securities and index-based products could help, because it's a simple product that pays out. So I think simplicity across the spectrum.
Very interesting thought. The idea of simplicity, we heard that this morning with Oliver. He had this idea of, you know, we have the terms and conditions that we have to do by regulation, but he quoted this example of Rose, then, you know, that basically made a short translation for the consumer and gave them in a nutshell the advantages, the upsides, the downsides. My fear would be, you know, you do that for a while and then you'll have guys like Gabriel coming and saying maybe we should regulate that too. So we have to look at that. Is that Susan, you are now, I think, relatively new to the industry. You came from an entirely different set of the economy. I think 8 months now in your job. You have a completely fresh look on our industry. I'm curious, how do you see these developments? You are now leading one of the biggest associations in the US. Very interesting job at a very interesting time, I think. Share with us where you are in these debates and how that reflects what we have heard just here from the regulatory side, from the consumer and the European industry, also in your debates in the US.
Well, thank you. First, I'll thank Michaela. She came and visited me, or was visiting Washington, and we had a chance to meet in October, and she said, I hope you will consider coming and being part of this panel. She said, I promise it's a very distinguished group of speakers. So now that I'm here and get to meet everyone and know their background, I feel honored to be part of the conversation. Having heard the speakers earlier this morning, Andreas and Oliver, I don't know how fresh this perspective is. I think they were absolutely right on. We need to lean into the elephants in the room as it relates to societal concerns, and we need to put consumers' interests first. Obviously, representing an association that advocates for good policy on behalf of the industry, I tend to think of things that in terms of policy and how do we advocate for that on behalf of the life insurance industry in the US. And I think the new thing that, which shouldn't be new, particularly as you listen to the eloquent speakers this morning, but turns out to be new, is to start with those lenses. What are the societal concerns that need to be addressed, and what are consumer interests, and how does that intersect with our own business interests? I actually talked with some congressional staffers as part of starting this job. You want to know what your customers, so to speak, think about you and think about the industry. And they said, not just you, not just ACLI, but every financial services company or representative comes into our offices and talks about what's wrong with this proposed law and how will it hurt their business. And it is always a very technical set of arguments. We're here to solve problems for people. What do you have to say about that? We've had similar conversations with our regulators at NAIC. What do we think about the big problems that need to be solved? How do they affect people? So it sounds straightforward and obvious, but it's sort of a transformational way that we're using to approach advancing our agenda. As we think about our work, we represent 95% of industry assets in the states, but that also means we are providing service and support to 90 million American families and addressing their financial security needs. As we think about some of the things that are unfolding, big demographic changes in our country, how does that role and mission evolve? We are on the path to becoming, it's a phrase we have in the States, a minority-majority country, which means that racial and ethnic minorities will at some point supersede the traditional majority population in the country. States like Texas already are minority-majority states. We're on path to being a minority-majority country by the year 2050. What are we doing to address the needs of all Americans, regardless of race, ethnicity, gender, socioeconomic status, stage in life? You heard Andreas shared some statistics as it relates to Europe about the role of women. 42% of women in the US are now primary breadwinners. Over 60% are co-breadwinners. We live longer. We tend to live alone because we live longer. We have pay gaps. There are retirement savings gaps. There are things that are specific to women that we need to be thinking about, not just from the standpoint of the business, but policies that we're advancing. So we actually have a framework that we're using for every, we call it having a for position. What is the American Council of Life Insurers for in terms of addressing needs of society? If you think about it as a Venn diagram, there's the societal needs, there are consumer needs, and there are our needs, and it's that spot right in the middle of the Venn diagram, the intersection of all three of those things. That's how we're putting our policy positions together. Every policy position we have to be for a solution, and then that's supported by, of course, facts and data, other things in terms of how it will affect people's lives. So I think from our standpoint, I can only speak for the states, that shouldn't be new, but it is new, and we're finding it clearly transforming in the nature of the conversations we're having with elected officials in Congress, regulators at NAIC, governors, and those that are very, very important to us.
So if I wrap up a little bit the first round of debate, a plea for simplicity, clearly, to make it easier to understand the products, the engagement. I heard also the human factor, the advice. We will come to that, I think, in a moment when we also speak about pension. But then also, I guess what we are looking to do, certainly now I'm putting on the European hat. We are ahead of a new commissioner, head of a new parliament. This engagement now, how do we translate what this industry can do for the consumer into a framework that helps us doing it easier in the next part. For now, we found ourselves a bit struggling also with and against regulation. and we'll see how that develops moving forward. I move to the next point. We had this morning already the statistics about people living longer, luckily, but as a result we have also the downside that pension pots, public pension pots, come increasingly under pressure. It is a topic that also the Japanese G20 presidency has now for the first time put high on the agenda. And it is something that also is very active in our debates between insurance industry, regulators, supervisors. So I'm particularly interested in your perspective. You are a trustee, and in the UK at a pension trust. Sorry, did I get it right? And you have you had in the UK, I think 2-3 years ago, a reform that would also that is called pension freedoms,
yes,
and where people can basically cash in their pension pot. What is the experience with this? Has this helped? How are things developing on that basis?
Yeah, I should probably first say that I think many people may know, but we also now have auto-enrollment into a pension. So the People's Pension, my friend, so we have 4 million members from, dozens and dozens of very small firms. And engaging those 4 million people is quite a challenge, but maybe we can talk about that a bit later. So pension freedoms, I think has been described as a policy car crash by many commentators. I think the issue was that it was announced in a budget, which meant that nobody knew about it. Probably the industry maybe had 48 hours notice, even the regulators weren't really aware of what was coming. And when nobody's prepared, everyone's trying to play catch up all the time. So the minister at the time very famously said, it'll be great, you can all buy a Lamborghini with your pension. And of course, most people would be lucky to afford the wheel of a Lamborghini with their pension pots. So what's happened? Well, obviously there's a massive transfer of risk to the consumer, who's really ill prepared to deal with that risk. You do get a lot of people cashing out, mainly small pots, but a lot of people then paid too much tax or found that they were no longer eligible for benefits. They took the money out and a lot of them put it in the bank. They put it in the bank because they didn't trust their pension provider. So that was quite a bad outcome for a lot of people. We saw a huge increase in scams, because of course scammers are a lot more nimble than regulators, it has to be said. So people have lost thousands and thousands of pounds to things that were too good to be true, really. Massive returns on their pension. In the drawdown market, which Vicky's already talked about, we saw people just taking the thing from their pension provider. There's a huge spread of charges for drawdown, which can massively affect the amount people will get over their lifetime. Now, the government did put in place a service, to give people guidance, not advice, but guidance on some of their options. But the problem was the way pension freedoms were sold, it was like, take it, it's your money. So by the time it was too late, at the point of retirement, people had made up their mind they were going to take the money. And so any guidance in the world would have sadly made no difference. And the final point, of course, which is in some ways the worst of the lot, is the DB to DC transfers. And the FCA recently found that you have to take advice if your pot is worth more than £30,000. The FCA found that and there were advisors queuing up outside British Steel to try and get people to cash in their valuable DB benefits for a DC pot. Because the amount of money was huge.
but then you translate it over the remaining lifetime.
Yeah, and the problem is, of course, annuity is a very poor value, but when you ask people what they want a steady income, they want it to last as long as they live, they want to know what it, they want an annuity, really, but then they were being pushed. You can still get them because they're the worst value. So the FCA found that less than half of the advice to people who were seeking to transfer their DB pensions was not appropriate. They'd been misadvised. So there's a huge mis-selling scandal waiting in the wings here as well. So it should be okay, but of course, because none of us could plan for it, it does look like a bit of a car crash at the moment.
Okay. So what are then the next steps? Turning to the regulatory side, is there a role for regulators also to help consumers making the right decisions?
Yeah, I mean, it's I sort of answered a little bit the question earlier. It comes to whether a regulator, as opposed to the government, should have a role in nudging consumers directly, rather than dealing with the firms. I think it comes to that. And I mean, to be frank, in the UK, as Sue has said, I mean, at the moment, there is legislation by government that you have to have this free guidance if you're going to do it. So there's kind of, it's mandating people to do something that they wouldn't have done it if they had free will, that we used to sort of so much, of course it's still value, but kind of to the pedestal. But the role of regulators in that front is, I think, to work with governments and provide the regulatory environment that will facilitate these consumer choices. And I do agree that when radical changes are made in a particular policy, it is so important to have pre-planned them. I mean, in all particular aspects, and this would have been planned much better. Would have been better outcomes for the consumer if there was sufficient planning.
And we are moving within political cycles, so I guess that plays a strong role in these kind of decisions.
But it kind of shouldn't be. It was basically a tax measure. So it came from the Treasury, and the secrecy that surrounds the budget just meant that the way if it had been announced in a different way, it would have been fine. But because nobody had more than 24, 48 hours notice. I don't. When did you know about it?
I'm not sure but generally it's government policy in the United Kingdom that budget decisions, for all reasons, because of course they are very important, Scotland and new stock markets, they need to be kept pretty confidential. So it's very much on the need to know basis for particular reasons. But it's not sort of a criticism to the government. It's just going back to the fact that I do think regulators need to take behavioral economics really seriously in regulating people. I mean, it's quite interesting the point that Sue noticed about annuities. So if you ask, there has been studies, I think there was a study by the FCA, that you ask a set of people exactly the same question about what investment products do they need in retirement. They describe an annuity. And then when you ask them the question, do you want an annuity? They said no. So the framing, that's how rational the human being is at the top of the pyramid. And we have to accept that and work with that.
I come to you in a minute, Susan. We have in Europe this debate about the pet now. Can I actually say, it was very interesting what you said. The timing is so important, and to take time to make the right decisions, to set the scene, to face in. With PEP, we didn't necessarily have the feeling the time was taken to think through all the options. There is now a strong onus on IOPA, I think, to fix that and to define a lot of the issues that the regulators have left open. But also in that period, consultation is foreseen. And if IOPA would really do consultation plus consumer testing, which in this field is paramount, I simply don't see how it all adds up. But okay, we will see whether, you know, we get the time to produce a quality result at the end. Susan, we had a lot of discussions in Europe, you know, when it comes to pensions. Do we have the right prudential framework? There is a bit of a discussion that we have, as you can clearly see from this morning's intervention. There is also a big discussion on the conduct side. How do we best advise our citizens about their pension options? Do we need to advise at all? That was a question that was discussed in Europe. Where are you in the debate in the US?
Well, in the US, I think on the positive side, for all of us who work in the policy advocacy space, you know, first you have to have political will amongst policymakers to actually agree there's such a big problem that we have to figure something out. And we're definitely at that place where the retirement savings crisis is only going to get more intense as we have baby boomers retiring at the rate of 10,000 a day between now and the end of the decade. We have our Social Security system, which was never intended to be a full government-sponsored retirement program, was always meant to be supplemental. It will not be able to pay its bills in 15 years. So there's wide recognition that we need to lean in on this. One of the pieces of policy that we, as part of having 4 positions as an industry, have decided to embrace and actively advocate has sort of an interesting combination of the nudge for the consumer and a mandate from government in terms of what the private sector needs to do. I personally believe it strikes the balance very well between the what could be seen as an excessive use of government in people's lives, incentivizing the private sector to help solve the problem and sort of getting the job done. The policy has been proposed by the chairman of the Ways and Means Committee, a man named Richie Neal, a very powerful committee where all the sort of action needs to come from in this space. And what it would do is require any business with more than 11 employees to offer a retirement savings vehicle and automatically enroll employees in that. Now there's an opt-out provision, so there's some semblance of choice, but we know from behavior economics that the majority don't opt out. So the combination of these things would provide access to retirement savings to 30 million more Americans, of which we estimate at least 22 million would take advantage of it. So that's going to go a long way down the path to helping address the retirement savings crisis. The big controversy in this, of course, is the mandate on small employers and their very powerful political constituency in the states, one that many elected members of Congress and in state houses live in fear of them marching on their offices. For us to take a position as a business group in favor of this legislation, we're the first to do it. I love the leadership position because, again, it has all the elements of a sound piece of policy that's really going to address. It's not a big, vast new government program. It's not a tax increase, and it's going to get 30 million more Americans. So we decided, after our construct, what's good for consumers, what's good for society, what's our core position, that we're going to be all in on this, and we're actively trying to advance it. People are delicately asking about our politics in Washington right now. It's fairly tumultuous. You don't have to be delicate at all. Not much is going to happen between now and 2021 after we see what this next election brings, but it's a critical time actually for people in the role we have at ACLI and elsewhere to lay the groundwork so the minute the elections are over and the new Congress and the new president are sworn in, we can drive forward as fast as possible. So I've got great energy around this. Again, all the stars have aligned. People know there's a need. I think this is a very, very adroit piece of policy, and it's one that I'm very proud we've agreed to lean into.
Yeah, but again, what I see is very mid to long-term vision that you have, that you are building up over the next couple of years. Very interesting. And I'm sure we will remain in dialogue about that. And we have seen very positive results on auto-enrollment. There are opt-outs, but in the UK it was, what, the range?
Yeah, the opt-out rate is still quite low. It's all employers in the UK. Even if you have one employee, you still have to do it. But we put up the contribution rates gradually, so it's now 8%, including the employer contribution and the government contribution. The challenge now is that although we've got a lot of people now in a pension saving, that's great. Some are missing out because they're below the earnings threshold, which is mostly women, so we need to do something about that. But the challenge is that actually people now thinking, so you nudge them.
Yeah. What do you do afterwards?
Most of them are in the default fund. I think in our pension fund we have 99% in the default fund. And 8% is not going to be enough if that is your only pot, because our state pension in the UK is very low. So there's another, I mean, it's good to get that far, but there's another challenge coming now that we have to, I'm thinking about for my 4 million members at the moment.
Okay, a topic that will keep us busy, I'm sure, also in future debates. Let me move on to Elisabeth. Sustainable society. What can the industry really do to protect, and what is it that we can contribute from your perspective?
Yeah, I would say, well, unlike other financial sectors, insurers have to play a double role when it comes to the topic sustainability. On the one side as institutional investors, and on the other side as insurers. Looking at institutional investor, of course, diversification of the portfolio is the key topic, and therefore I think we strongly advocate the holistic approach of sustainability, consisting of all the three factors of the ESG principle: environmental, social, and governance, of course. Concentrating on only one aspect maybe could lead to very negative results. For example, an environment-friendly product from child labor under a tax avoidance regime. I would say the upcoming European regulation under the title Sustainable Finance will be a very important framework for sure for our activities, in particular the EU taxonomy that shall answer the questions of all the questions: what is sustainable? So therefore it's very important that we get a point of reference for the financial markets, maybe or hopefully a role model for other parts of the world. The current focus of the EU taxonomy, this is a difficult word, is on only one aspect at the moment, the environmental. And in the interest of a well-balanced approach, I would say we should request a clear commitment and a timetable for also integrating the social and the governance factors into the regulation. And in the area of social factor, I would say insurers as long-term investors can really make a substantial contribution to an emerging issue in many member states. I would like to mention the topic affordable housing, because the European Commission identified an affordable housing investment gap of 57 billion euros. And we as VIG, we are already investing for more than 30 years in affordable housing in Austria. We offer more than 100,000 apartments to lower income families. I think affordable housing is perfectly fitting into the sustainable development goal of the United Nations, with sustainable cities and communities. And next to the United Nations, also the European Parliament referred also to housing as an important element of sustainability, And therefore, in my opinion, also the debate taxonomy should cover this topic. And if I could send a wish here, I would like also Solvency II to cover this topic, of course. And let me come to the second role, the insuring topic. I would say, and this question was asked before, we are protecting what matters as insurers to the citizens and to the business. And already by now, so we take into account sustainability risks in the form of increased frequency or severity of natural disasters. I would say we are risk taker, of course, and so we are also enabler of many activities like renewable energy production, and I'm quite sure that this role will significantly grow in the future. Therefore, we should be prepared. And in my opinion, the EU insurance regulation and also Solvency II should maintain, and I think Andreas already has mentioned this too, a risk-based orientation and should avoid any artificial incentives or punishments in the form of decreased or increased capital charges. This does not preclude future adjustments in case of some risks. We are moving towards a data economy, and also this has been mentioned by Andreas. I think risk data and evidence is of course important, will improve, will for sure improve in the next years over time, and this evolution will also be reflected by the capital charges.
Yeah, I think that was a very long list. I think you summarized pretty much what, you summarized pretty much a lot of the asks that we have also come forward, I think, as an overall as an industry. At the European side, I think also in the presentation that we had from Alan Pavlov, there was also the question raised, what is happening in other parts of the world? I know you have these discussions on sustainability in the US. I will also ask you, Vicky, shortly, because you obviously have also the outlook on across the world on activities. Can you give us a bit more insight? Where are you in this debate in the US? How is it developing?
Well, from the life insurance perspective, we're looking, there's climate change sustainability, but then there's also human resources sustainability, so focusing on not just retirement security, but an issue, because we're so backward compared to the rest of the civilized world in terms of paid family medical leave, which really refers to the ability for parents to take time off and have some income while they're having a child, caring for a child, caring for an elderly relative. That's a big issue that we're leaning into in an aggressive way. And then also, as we're looking at our investments, we are the long-term patient capital. We are, I think, critical to the American economy and how the industry is thinking about its investments and thinking about policy that can help us support more things that are critical to the health of communities, whether it's in the Obama era, Obama administration era, we had USA bonds, buy for USA bonds, and we were the third largest holder of those bonds, which built roads and bridges and schools. That's certainly a policy area that Congress and the Trump administration have talked about. Again, unlikely anything will move between now and 2021, but it's an area of debate that we're going to focus on.
Okay, very interesting. Victoria?
Yes, we will come, basically my short answer is that regulators have a huge stake in on sustainable investment of all types, including on climate risk. But I know that we'll come to climate risk later, so I will make
a time. So if you want to say a couple of words, then yes. I prefer you.
And the reason being is very, very simple. It's because, take climate change, which is one aspect. This is not a risk that may happen. It's a risk that will happen. It's foreseeable. And we are living the tragedy of the horizon. That is, our generation, the generation of our parents, are not shifting to do the right thing early enough because the risk is in the long horizon, and that means that the risk will be much more severe for our children and grandchildren. So we still have a chance now, and there is a new horizon. Now, why is the risk that should worry me as a prudential regulator, as an insurance regulator? The answer is simple. It's because as an insurance regulator, insurers are exposed to physical risks on property, loss, transition risks, because at some stage the world will realize that we will have to shift away from coal-intensive industries and other industries to others, and they might be stranded with assets, and that are not worth very much, and liability risks, because they insure others against property risks and asset risks. So actually we have a huge stake because we need to get our firms ready for these risks that ensure that our firms are preparing for themselves, let alone for the opportunities, for the risks that they're actually taking. And I mean, we at the Bank of England, the BRA, last month published, I think we are the first regulators to have done so, supervisory expectations for all our insurance companies and banks on what they should do against climate change risks. And they're around governance with particular responsibilities for a senior management function, they're around risk management, they're around scenario analysis, and they're around disclosure. So internationally, there is an important network, the network of greening the finance, which started with 8 central banks, mostly European and China actually, and it has now expanded to more than 30 people. They published the first recommendations again last month, and they are around risk management, and they are around scenario analysis and disclosure. Also internationally, and that goes beyond the financial sector, but it was an initiative that was supported by the Financial Stability Board. We of course have the Task Force for Climate Risk Disclosures, which has been a huge success with 8 trillion worth of companies representing 500 companies representing 8 trillion worth of assets disclosing under the framework. And of course, it cannot only be financial companies. We need all companies because of the supply chains. But there's still much, much more to do. And although the disclosures are happening, they tend to be less quantitative because we have a data deficit that was being mentioned, and we need to do something about it. We in the UK are considering the Bank of England very seriously advocating, because again it's something that we need government to act on, about mandatory disclosure. And we have set up a risk forum with the industry, banks, insurance companies, asset managers, because this is a systemic issue, the London Stock Exchange and the conduct regulator, to try to get best practice on what these disclosures might look like. At the IAIS, we're working with the UN Sustainable Insurance Forum, which is an observer at the network of greening finance, to publish a paper on how supervisors can supervise against the risks on climate change, and on how they can nudge the firms to disclose better. It's a paper that's coming through this year. Finally, on prudential charges, because of course regulation is not only about capital and prudential charges, it's about supervisory expectations of other things. Now, there, I am a firm believer, and my members at the IAIS, when we have had the discussion, there's consensus on this across both sides of the Atlantic, I'm glad to say, that we are not in the business of requiring less or more capital for social reasons. It needs to be risk-based.
Yeah.
So if there is evidence that sustainable investments, ESG investments, green investments have characteristics that make them less risky, then we will take them on. There is emerging evidence that this may be the case in certain cases. So take, for example, the evidence on green mortgages and in particular sustainable infrastructure projects, but it is emerging. And of course, it goes back to the point that Elisabeth said, in order to put these things, if they're risk-based, into prudential capital, you need a taxonomy that then gets mapped into a qualifying asset class. And to be frank, I mean, I am waiting with bated breath the results of the European Commission study. And I'm all very, very familiar about managing international committees. But these debates can get, let's be frank, quite political. So I would also urge the industry and rating agencies to start going out and doing classifications of what it actually is, because the industry ultimately is facing huge transition risks, and it needs to know what's green and what's not.
Good point. I don't know, you wanted to come in with something soon, yeah?
I was just going to make a point very briefly. As I mean, as a trustee, you know, we're already feeling the pressure on ESG investment, taking climate change into account. But I think we'll also increasingly see, especially amongst younger people, they actually care where the money is invested. We offer an ethical fund, as a lot of pension funds do. At the moment, it's a tiny number of members. But I think we will start to see investor member pressure for more ethical investment. So I think it can happen both ways.
Yeah.
I think it'll take a very long time.
I wanted to say that it's again, we are back to the timing element in the whole debate. It's a bit a running theme through the red line that runs through our discussion today, but when we discuss it also internally, I mean, what we see right now is green assets. First, we always have the problem, are they truly green? But okay, you take your best assessment. But then green assets are massively oversubscribed once they hit the market. There's an undersupply. There is a huge interest in these assets, but simply not enough. So to get this addressed is obviously also key. But then as an insurer, you also have the social element. You know, you are an industry that protects. And you protect not only the coal mine, but also the people who work there. You protect it against damage. What happens if you withdraw your protection and something happens? You don't have a contractual lever to really take care of the damage and to settle the claim. The taxpayer will then eventually be called to action. These are all things that, you know, there is lots of will and interest in the industry to do the right steps and to move in the right direction. But again, we have this timing element, you know, do we get the assets? Do we get the support? Can we withdraw the protection? All these are questions that are very active in our internal debates. We have 5 minutes left, and I now turn to the audience. If you have questions, then please send them in. I have a first question. It's clearly from a European representative because it's relating to PEP. And the question is, will it be a deal breaker or failure to help to close the pension gap in Europe? So I'm turning to the European representatives. Any views?
Maybe not for long, but yeah, we are. Yes, it should make a difference. But I'd just like to echo the remarks earlier about preparation, consumer testing, and really understanding what people want and need.
Any views from you?
Elisabeth? I think this is quite clear that this is one of the biggest challenges in Europe, and following those statements from before, I would say it's all about the situation. My money's gone, but I'm still here. Yeah? And we have to look how we can solve this, and I think if we can combine both social security systems and private pension systems, this must be and can only be the best solution.
Yeah. Victoria, any views on that? Okay, I'm checking for other questions. A question also to the industry. Do you have experience, are customers already showing strong demand for sustainable products? I think you responded to that to an extent. I have the privilege of sitting on the IOPA stakeholder group, and we had a discussion there also about sustainable assets, obviously also in the pension discussion. And it was quite interesting. There, the number of consumer reps then saying, if you ask a consumer whether they prefer investing in a sustainable asset, they will all say, yes, we really like that very much. But then you need to make sure there is also the yield in the end, you know. And that is exactly where we come again to the crucial issue. You know, how far can we go in nudging them towards these kind of products when we do not yet have the clear idea of what will be the outcome at the end?
It's, I mean, there is increasing evidence that particularly the new generations are demanding that this has become more mature, that there will be greater demand. I mean, there is, in terms of green bonds, for instance, there have been studies that have shown that they do trade at a premium relative to other non-green bonds with the same characteristics. And most of the explanation is because there is this kind of excess demand for them because investors like them. However, I mean, another point is that green assets might not only become more desirable because consumers want them more, or investors want them more because of the social characteristics. They might actually be more desirable because the providers that are producing them, or the insurance companies that are buying them, might be seen as being more long-term and more robust and more strategically resilient as a proxy to the long-term horizons a company has. And not short-termist and therefore long-term. So you might actually see a premium because of that too.
Very interesting thought. I'm checking whether there are other questions. So far I haven't, but in any case we have come to the end of our time. So I would invite you to thank my splendid panel here for their very active and lively contribution. And very happy to have had this debate here with a female panel, and looking forward to the next one that we hopefully manage again in 1 year's time.